Learning Unit 5 in the actual textbook, the liquidation of a partnership. As I go through some of the points here, we'll obviously recap some of the important points from the actual notes last week. We ended last week with the theory, and we went through the slides looking at those different steps that you need to go through when approaching either a simultaneous liquidation or a piecemeal liquidation. All right, so first thing we need to look at is just a bit of context. Let's see what they've given you here. Okay, learning outcomes, key concepts. This is quite important because we do need to know what the differences are. So let's start with the word dissolution. How would you describe that? What is a dissolution?
I remember you were saying it's like when a marriage ends. That's what I remember.
Okay, yeah, it's similar to a divorce, but for a partnership, this would be a what? The dissolving of a
Like,
business, right?
yes. So like the end of a business.
Okay, so a partnership agreement is a contract, right?
Yes.
Okay, what happens if you admit a new partner? Let's say you've got A and B, and now they're going to admit C. What's going to happen to this partnership between A and B?
It's gonna dissolve.
Yes, okay, so when you're looking at, I think dissolve is double S, eh? Yeah, it looks like it, yeah, double S. So when you're looking at a partnership, and if you've got A and B, and they're in a partnership, and they want to admit C, what's going to happen to A and B's partnership? It will no longer exist. So you're going to basically start over where you'll have A, B, and C all in a new partnership. And all of them will have to sign a new agreement to make sure that all the rules are in place for that particular form of ownership. Okay, liquidation, what is that?
That is when you sell all your assets. So a liquidation will happen when your liabilities is more than an asset, and you have to sell all your assets to pay off to your creditors.
Very good. Yes. Okay. So a liquidation process involves the sale of those assets in order to realize cash. So that's different to a dissolution. A dissolution could be also part of a liquidation, but if you're dissolving a partnership, it could be because A and B want to bring in C. It doesn't mean the partnership is going to be sold off and the assets are going to be liquidated. It just means A and B will dissolve their partnership and a new one will exist between A, B, and C. Right, so the words are similar, but the accounting is different. So with a dissolution, there could be a change in ownership that would lead to a partnership being dissolved. With a liquidation, now we're actually looking at the sale of those assets to cover those liabilities in order to then pay out the partners, and then obviously they're going to go their separate ways. Okay, so a liquidation, okay, could be because of maybe adverse economic conditions. So a partnership deciding to close because it's not worthwhile and maybe the business isn't profitable. Okay, so those are considerations that we need to look at in terms of the theory. So we need to remember that partners are separate. Okay, so each partner will have to submit their own tax return, would have to have their own income and expenses and all of that. Okay, the partnership is just the business that operates inverted commas, okay, on its own, but for the benefit of the partners. Okay, so it's not a separate legal entity, but it's separate from an accounting point of view because you need to work out what is appropriated between the different partners of the business. Okay, a liquidation account, we saw it last week, we're going to see it this week, it's a working account. There are lots of different working accounts that could come up in 1601. Okay, the one that you've seen before, valuation. Okay, that's an important account. And even before that, the appropriation account. Okay, appropriation is used to allocate profit within a partnership. Liquidation is obviously what we're going to be looking at here. Okay, where you're selling off everything. And the other one, which was the valuation, is when you have a change in ownership. So in other words, A and B admit C, or A and B have let's say, yeah, a change. So in other words, You could be bringing in a partner, there could be a partner that's retiring, whatever the case might be, but there's something to measure in terms of their equity. All right, simultaneous and piecemeal, we'll see it in this set of notes. Okay, we'll look at it in this chapter. Just to recall the notes from last week, the summary, simultaneous means sell everything, get whatever you can, and then split it between the partners, and then everybody goes their separate way. Okay, if it's a piecemeal liquidation, the partnership stops operating, but you're going to be waiting to sell those assets. You're not going to just sell those assets and realize losses perhaps. Okay, you're going to sell those assets as and when you feel it's advantageous to generate the most return on investment. Okay, because you don't want to sell assets at the end of the life of a partnership where you're going to realize a loss and there's going to be almost nothing or very little for the partners to take away from the business. Okay, so piecemeal is looking at stages. Okay, so step 1, step 2, step 3, step 4. There could be multiple steps in the process in order to get to a stage where you've sold everything and then everybody goes their separate way. All right, then the last note here on this set of key concepts, loss absorption capacity method. This is used in the piecemeal liquidation. It's part of the process. It's a measure, or it's a system. It's like diminishing balance or straight line method. Okay, it's a method that's used to deal with the piecemeal liquidation because A, B, and C are in a partnership, and now we need to decide, okay, who's going to get paid out. Okay, who are the responsible partners and who are the irresponsible partners. Obviously, in a piecemeal liquidation, you're not going to pay out, okay, the person with the lowest capital, okay, and then leave the others in the business. Okay, you pay off the partners that were entitled or that are entitled to the most benefits. All right, and that's based on their operations. In other words, how did A conduct business in the partnership? How did B conduct his or her business in the partnership? In other words, did they draw too much, or did they invest or save a lot of their capital? Okay, remember, drawings is how partners get paid. Okay, partners draw from the business. All right, there's the note. Eunice has given you a bit of introduction here regarding the liquidation. They're referring to the two different methods, piecemeal and simultaneous. Good. Okay, some theory questions here. These you can actually look at just to practice. The answers are there, so you can just check your answers. We know what those liquidation methods are from last week. The liquidation account is a working account. That's important. It's a T account. Right, so you'll have debits, you'll have credits, and you'll have a total to balance off this account. Okay, you're not going to have a balance brought down, balance carried down. And then you'll obviously apportion, okay, the entitlements to either of the partners, okay, depending on who gets what. All right, so just some background here. You can have a look at this. Let's see. Okay, the process. This is actually something that I had given you in the actual notes. I took it from the textbook. I think they've also done the same thing. Okay, they said as suggested in the textbook. Right, they're referring to the textbook. But if I recall correctly, I think you weren't required to buy a textbook for this module, right?
No, we were.
Yeah,
you
were.
It was
So
just
you do have a
FAC.
textbook.
Yes.
Okay, great. All right, so yeah, that's good. So the textbook is a great source of background information. And if this is coming from the textbook, which it looks like it is because the steps are very similar to the ones in my notes, you'll see here they're talking about simultaneous. So simultaneous means sell everything, realize cash, pay out the partners. Right, so how do you do that? Well, you need to close off drawings and current accounts to capital. Okay, we know that. Again, just to revise some basics from a partnership perspective, capital represents the owner's equity. So because you're dealing with partnerships, you'll have capital A, capital B, capital C, etc., depending on how many partners you have. Right, so equity is very important, right? Because if the partnership is going to be liquidated, we need to know how much does each partner get, or how much is each partner entitled to, right? So we need to close off drawings and current. We need to close off goodwill and the revaluation surplus. Okay, again, revision. Goodwill is a non-current asset. Goodwill has a debit balance. When you close off a debit balance, you would credit the goodwill, okay, and then you would have to debit the capital. Okay, so we spoke about this last week. I'm just mentioning it again because it's so important. Goodwill is a good asset to have when the business is a going concern. So if we're going to continue operating as a partnership, the goodwill is good. Okay, if it's going to be ending, so in other words, if the partnership is going to be dissolved or liquidated, okay, liquidation definitely is going to give rise to a detriment here in terms of the goodwill having a negative impact on the business. Right, because who's going to buy the goodwill? No one. Okay, no one's going to buy the, inverted commas, reputation of the partnership. Okay, you just can't do that for a partnership because the partnership actually ceases to exist the moment it's liquidated. Right, if it was something different like a company, okay, companies do account for goodwill, right, but you don't cover that in this subject. Okay, you might look at it in later accounting modules if you do cover more of these topics. Okay, but goodwill is also accounted for in terms of companies. Goodwill is just that. It's the reputation, it's the brand, it's all the effort, all the time that was put into the business since the business was created. Right, so if A and B were operating since the 2000, okay, since the turn of the millennium, and they were operating until 2020, okay, in 2020 they decide to liquidate. Right, obviously there might have been a change in ownership somewhere along the line. Let's say in 2010, okay, we brought in C. So we now have A, B, and C. Okay, when we brought in A, B, and C, in 2010, you would have accounted for goodwill because C would have paid for a share of the business. And then you would have done a goodwill calculation, okay, and then you would have accounted for the goodwill in the books of the business. Goodwill would have been recorded as a non-current asset in the statement of financial position. Okay, so now A, B, and C are running the business for another 10 years. Okay, in 2020, because of COVID, A, B, and C, they're going to close the business because it's not worth operating and they want to go somewhere else. Sorry, Cheryl, can I take this quickly? It's quite urgent. I was expecting a call. Sorry, I didn't say that earlier. Can I take this quick?
Yes. No.
Okay, perfect. All right, so Cheryl, when looking at the accounting for a partnership, remember we said that equity is important because the goodwill would be relevant and it would be attributable to the partners when they're operating as a going concern. Okay, obviously, if goodwill is a non-current asset, it's a debit balance, and when you created the goodwill would have been debited and then you would have credited the capital. And we saw that in those workings last week when we had a change in ownership. Okay, so when you create the goodwill, you debit the goodwill and you credit the capital. So when you remove it, in other words, when you get rid of it in a liquidation, no one's going to buy the goodwill separate from the business because the business is the goodwill. The business operating creates the goodwill. So because the business is being liquidated, you're not going to have any goodwill, and that's why you're debiting the capital. Okay, so goodwill is great when you're operating as a going concern, but it's not if you're going to be closing the business. That's something to consider. Does it make sense?
Yes.
Okay, perfect. And then the last bit is just the liquidation account. With the simultaneous liquidation, it's nice because you're only going to have 3 accounts to consider. You're going to have liquidation. This is something you could maybe write down either on the notes or separate, or even on the study guide if you've got the hard copy of it, or even soft copy. You can actually save this if you want to. But just to highlight this, okay, when you do a question with a simultaneous liquidation, you'll have these 3 things. Okay, a liquidation account, you'll have a capital account, well, counts, I should say, because there'll be multiple owners, in other words, partners, so capital accounts. and then bank. That's it. Right, those are the only accounts you're going to have open.
I have a question,
Yes.
Anthony. If I had, okay, so say a business is going through liquidation and we sell the property.
Yes.
So to close it off, I'd credit the property account, and would I debit bank or would I debit the capital?
No, well, first of all, because you're liquidating the business, everything needs to be sitting in the liquidation account because those are the only accounts you're going to have open. So you're going to close, okay, the property, the land and buildings. This is going to be first closed to that account.
Oh,
Okay,
okay.
if you had vehicles, same thing. Vehicles closed off to that account. So because this is simultaneous, that's why I'm trying to stress that point. That simultaneous means sell everything, okay, get whatever you can. So everything is sitting here in liquidation. You're not going to have any accounts open. You're not going to have land and buildings. You're not going to have vehicles. All of those accounts
Okay.
are going to be closed off to liquidation. Everything that you're selling will be sitting in liquidation, waiting to be sold.
Okay.
Okay, so you're only
Okay.
going to have these accounts: liquidation, capital, and bank. Right, so if you're
Okay.
selling the land and buildings that you're liquidating, you would debit the bank and you would credit the liquidation. That's all you would do. You're not crediting that account. Okay, it's a working account that's showing all the closing off of those assets and liabilities. So everything sits in one account. That's the easiest way to put it. So simultaneous, everything is sold at once. So everything is literally sitting in that account.
Okay.
Okay. All right. So yeah, you'll see it just now. When we look at activities, there should be one looking at liquidation. We saw it in the assignment as well, but obviously we haven't covered the theory then. But now we have, so it'll make more sense when we go through these examples. Okay, so activities here obviously refer to the textbook. Have a look at some of those examples. This is just looking at the capital accounts. Okay, we'll look at that when we look at the actual liquidation. Okay, it is possible for certain partners to be, inverted commas, okay, in a negative position. Okay, you would hope that the partners have some sort of capital in the business, but if not, okay, you can have a scenario where the partner would have to actually pay a certain amount to the partnership to cover their drawings because maybe they've drawn too much. And now, because you're liquidating the partnership, you have a capital account that might end up with a debit balance. Okay, that is possible. It's not often going to happen because hopefully the assets and liabilities, okay, the net amounts, in other words, after you've subtracted the liabilities, hopefully the net assets, so the assets that are still available, are sufficient to give the owners, the partners, some sort of benefit. So you shouldn't really get a debit balance on a capital account, but it's possible, okay, because maybe you had a partnership that was operating at a loss. And then obviously this could be a reality, right? And then they've got to actually, inverted commas, cover the loss or pay for the deficit. Okay. All right, that's what they're describing there. Let's have a look at this bit. Okay, this is piecemeal liquidation. This is in stages. Okay, so you'll have 1, 2, 3. You'll have assets that'll be sold in different steps or stages. Okay, so when you're looking at a piecemeal liquidation, it's pieces. Right, so we're going to sell pieces of the assets, not all of it. Okay, and it's done in a column method, okay, because you have to keep track of all the assets, all the liabilities, and all the owner's equity. Right, if you keep it separate and you're managing and monitoring all of those lines, you'll be able to keep track of the entitlement. In other words, what the partnership is going to be paying out to the partners. And that's done using the piecemeal liquidation loss absorption capacity method. Okay. They might even mention both methods here in the notes. It's in the textbook, but they've never tested the other method. There's the only one that this is the one that they test, loss absorption capacity method. And the reason why, it's because it's so intuitive and it makes sense. It's logical. Okay, so there are steps. Again, don't worry too much about steps. If you've done one question and you do lots of questions, you'll get familiar with the steps. Okay, as long as you're just remembering that you have to close off accounts, remember to capital, and then obviously you have to pay off liabilities first, right? So if I had to give you general steps, it would be to update the owner's equity. So in other words, close off everything to capital, the goodwill, the current, the drawings, whatever. Okay, process any valuations or anything like that. Right, then you would have to look at liabilities. Okay, close off liabilities, and then number 3, consider the assets. Okay, the assets would obviously be sold, loss absorption capacity method, and that you'll go through as you go. Okay, all right. So this we'll see in action when we look at a question. Okay, more examples to look at from the textbook. Okay, here's your first example. Here we go. So last week we looked at the theory, a little bit of recap just to start off in terms of content. Simultaneous simultaneous liquidation. Let's go to our notes. Okay, I'm going to put this as a separate worksheet. Okay, this is going to be liquidations. Okay, asterisks. No, I can't put an asterisk. Let's put a dash. Liquidations, simultaneous. Actually, let's keep it together instead of opening up so many of these tabs. Okay, so liquidations. Number 1. Okay, simultaneous liquidation. Let's have a look at the scenario. Okay, there, it's short, 1 paragraph. Pen and pencil, we're in a partnership for 38 years, trading as manual accounting services and shared profits and losses equally. Important. Okay, so pencil, 50-50 in terms of their sharing of profits and losses. Owing to a steady decline in the clientele and profits, they decide to liquidate the partnership, okay, at a public auction. There's the giveaway. Okay, it's a public auction. Auction means sell everything, get whatever you can, and then close the business, move on. Okay, so that's exactly what they're doing. On this date, just prior to the auction, you've got a trial balance. Okay, so manual accounting services, just before the auction, you've got all of these things. Okay, so we know we're going to have to liquidate the business. We know we're going to have a liquidation account. And the liquidation account will be big. So draw enough space or lines so that you've got enough space to write in all the different assets and liabilities. Okay. Liquidation. Copy this. Paste, paste, paste. Okay, what else did we say we're going to have open? Capital for pen and capital for pencil. Because we said, okay, when you liquidate the business using simultaneous, you have to have 3 things. Liquidation accounts, I've got it. Capital accounts, I've got it. And what else? Bank. Okay, money. Right, the money is going to be realized from those assets in the liquidation account, and whatever's left over gets paid out to the partners. Okay, what are all these accounts? Give me the accounting elements. Land and buildings? Accounting element, land and buildings, what is it?
Asset.
Good. Furniture and equipment? Well, furniture.
Asset. Anthony, can you hear me?
I can.
Okay.
Vehicles,
asset. Accumulated depreciation, negative asset. Goodwill is an asset. Inventory, asset. Trade receivables, asset. Allowance for credit loss, negative asset. Capital owner's equity or capital. Current account, also owner's equity. Revaluation surplus is also equity. Mortgage liability, bank overdraft liability, and trade receivables liability.
Good. Okay, once you've got all that, now you can close this off. All right, so obviously,
Okay. Sorry, can you just explain to me what revaluation surplus means again?
okay, revaluation surplus is when you have an asset that was valued at more than its current carrying value. So this could have occurred sometime during the past. So what dates are we looking at here? 2015, 38 years ago. Okay, so maybe, okay, 38 years ago. Wow, okay, that's a long time ago. What is that? 15, and then what do we have left? 23. So 77. 1977, you started the business. Okay, 1977, you bought land and buildings. Okay, let's say you bought the land and buildings in Santon. Okay, obviously land and buildings today is worth a lot more than in 1977. Okay, so at some point in time during the life of the business, there would have been a revaluation that could have been done on a certain asset, whatever it is. Okay, we don't know much about this revaluation, but we know it was a surplus. Okay, so it might have pertained to land and buildings. So then when you did the revaluation, maybe you did the revaluation in 2001 because of CGT. Okay, CGT came into effect in 2001 where government actually started taxing capital gains on those assets that were bought and owned by individuals. All right, so obviously there was a date that government had said, okay, go value your assets, okay, and tell us what the value is. Right, once you've got that value, then they're going to use that as the base cost. Okay, I don't want to look at tax, but I'm just sharing some information with you. That's additional information. Okay, it's not important for accounting. It's something separate, but it's relevant in terms of what we're looking at here in terms of revaluation. Right, so in 2001, you might have got someone to revalue your assets. In other words, land and buildings, okay? And they revalued the asset at 270,000 Rand more than what it actually was worth. Okay, but the numbers are small, maybe not so realistic in terms of the Santon example, but it's still relevant. Okay, the point is you've revalued, okay, those assets. You've increased the value of those assets. In other words, you would have debited the land and buildings and you would have credited the revaluation surplus. Okay, they didn't allocate this to the partners. They kept it separate, right? Because this revaluation surplus was done when there was a valuation performed, and it could have been because of legislation, or it could be because they wanted to value the business or certain assets in the business rather, not the business itself. Okay, does that make sense?
Yes.
Yeah, so it's literally just equity that they've just set aside, okay, for no one's benefit. So they're not going to allocate that because it would be silly to allocate this benefit to partners, because what happens if you allocate that to A, B, and C? Okay, if you allocate that to A, B, and C, now you make this reserve distributable. So in other words, if A is irresponsible, okay, A is going to draw more because A thinks he's rich, because A knows that the land and buildings went up in value. Does that make sense?
Yes.
Okay, so you don't want A and B to draw the value of the land and buildings. And that's why you have a revaluation surplus, to prevent irresponsible partners for taking advantage of the valuation. Right, because these numbers could have been bigger. It could have been add 3 zeros there. Okay, maybe. Right, if this was 1997, and let's say we bought land and buildings in 1997 in Santon, and it was prime property, okay, and now the same land and buildings, okay, is worth 270 million, okay, are you going to sell those land and buildings? Probably not. Okay, but who is going to get the benefit of that? A, B, and C. Okay, so now A thinks they're a millionaire because the land and buildings have increased in value. Right, if you allocate that to A's capital, A could take out all of its capital, and you're not going to be able to pay a portion. Let's say if it was a third, a third, a third. Okay, that means A is going to get 90 million in terms of benefit from that property that you bought in Santon. Okay, there's no way the partnership is going to pay 90 million to A and say, okay, you can draw 90 million, right? Because in order to pay A 90 million, they're probably going to have to sell the land and buildings. Does that make sense?
Yes.
All right, and that's why you don't do that, okay, when you have a revaluation of an asset that's important. Okay, this is an important asset. You don't want partners to take the value from the business, right? We want the land and buildings to stay in the business, and that's why we have a revaluation surplus. Because who knows? Back in 2001, it was worth 270,000 more than it was. Maybe sitting in 2020, now it's another plus 270,000. Who knows? Okay, but the point is, you're going to be valuing those assets when they change, or when there's a change in ownership, or when those assets need to be valued in terms of legislation. Okay, so this revaluation surplus is probably because of something that would have happened in the past. Okay, we don't know too much about that, so we don't have to worry about it. As long as you know what it is. Okay, what is it? It's capital. Okay, who gets the benefit of the capital? The owners. Okay, so revaluation needs to be allocated to the partners. Does that make sense?
Yes.
Okay, that's a benefit for the partnership. All right, so you went through the whole list. You told me everything, whatever each of these things were, okay, in terms of their elements. Okay, when you do a question like this, all right, the nice thing about this is, because you've identified land and buildings as an asset, and because you know that assets have a debit balance, you put that on the debit side of liquidation. Okay, it's nice to understand why. Okay, look at the land and buildings. What balance does the land and buildings have?
Debit.
Good. How do you close off land and buildings?
Need credited.
Good. So you would basically do this. Okay, I don't think UNISA has given you that much detail. Okay, because what did they ask for here in this question actually? Here, required. Prepare the, see, liquidation account, bank, and capital. Okay, that's probably what they're going to ask for in a simultaneous liquidation, because that's kind of all they can ask for, because the T account is what you're going to be looking at when you actually liquidate the business. Right, there's no financial statements here. Okay, there's no adjustments here, right? Because the business is actually closing. The business is no longer going to operate. Okay, so you can kind of expect that, right? If you've got simultaneous liquidation, it's going to kind of give away the required, right? They don't have to ask you for all three things though, right? Sometimes UNISA will only say do the liquidation or show the partnership capital account. That's all. Okay, they can't ask for everything. Here they've asked for everything because it's a worked example. Right, so they can show you how everything is processed. Right, so you know that you're going to have to draw up T accounts. So that's what they want us to show us, or show them. They don't want us to show journal entries. But you could have drawn up journal entries. And if you did, which I'm going to do, just as additional, so you have more insights, okay, you would have recorded this. 500,000, 500,000. There we go. Okay, debit liquidation, credit land and buildings. Right, would you do the same thing for furniture and equipment or vehicles? Yes, you would. Okay, so
yes.
You would literally do this for all the assets. Obviously, it just depends what assets. Okay, does that make sense?
Yes.
All right, but remember, only assets that you can actually sell, not stuff that you can't, like goodwill. Right, so that would be applicable to those assets. The furniture, the vehicles, and the equipment. What is the vehicles? 215. Okay. All right. And that's what you would have to show as part of the process to liquidate the business. In other words, to close off the business, because you're never going to see these accounts ever again. Right? All those accounts are going to be sitting here. Okay. So why do I want to show you this? Because that's the closing off of the accounts. What's important is that the working. Right. So what does that say I must do to this account? Debit the account. Okay, and what am I debiting it with? Land and buildings. Do you see that?
Yes.
Okay, so the reason why you show the land and buildings in the liquidation account is because it was revalued. Okay, so we need to obviously look at it, okay, in terms of the valuation. That's what they've told us. Okay, all right, so you'd literally put everything in here. So that's why I like basic. So if you know what these things are, you'll know where to put it. Land and buildings, assets, so debit side. Okay, so debits will be for assets potentially. Okay, assets, liabilities, income, expenses, capital, drawings. Okay, you're not going to have income and expenses here because that's operations. Right, so only your assets will go here. And then on this side, you'll have the liabilities. Okay, because you're closing off your assets and liabilities when you're liquidating a business. Right, so land and buildings, we've got the first one. And I'm just going to highlight these first three just so you can see it. Okay, this is the closing off of those accounts to the liquidation account. Okay, furniture, vehicles. All right, the land and buildings, 500,000. The furniture, 102. The vehicles, 215. Okay, what else do I need to close off? Well, all the other accounts, the negative assets. Okay, so negative assets, we could even put that there. Negative assets will have credit balances. So to close off a negative asset, what would you do?
You debit the account.
Yes,
And
debit
you
the
credit
accumulated depreciation and
credit liquidation.
perfect, good. See how easy that is. All right, so basics are very important. All right, if you can get the debits and credits, every debit has a credit, even when you have a liquidation or a valuation, anything. Doesn't matter what. Different color. Okay, credit the liquidation. So, credit the liquidation. Right, and why? It's because of the accumulated depreciation. Right, and you've got two here. How much? 20 and 15. Okay, goodwill. Okay, we spoke about goodwill. What are we going to do with the goodwill? How do we close off goodwill?
You would credit goodwill.
Yes, and then you debit the?
Capital?
Yes,
What is
good.
capital?
Okay, pen and pencil. All right, how much does pen get? Half of it. What is the goodwill? 120. Okay, so 60, 60, 120. Right, so goodwill will be closed off. I can cross it out. I can cross all of these as I go, okay, just to make sure I've looked at all of it. Right, and obviously there should be a balance here. Yes, there is. Right, your owner's equity, OE equals A minus L, or A equals OE plus L. Okay, or L equals A minus OE. Right, it has to balance. Right, in other words, the debits and credits have to balance, and so does the accounting equation. Okay, so I can see that the balance is balanced. I've got the full list of accounts. Okay, these are the only accounts that are left open in the accounting records of the business. All right, so goodwill we've now closed. How much does Pen get? Pen's gonna get 60,000 as a detriment, right?
Yes.
Okay, we would expect Pen's account to have a balance on the credit side if he's a good partner. We would expect Pencil to have a credit balance because hopefully they're a good partner as well. Okay, so goodwill needs to be allocated to each of those partners because we're closing off the goodwill. What is it? 60. Okay, next. Inventory. Okay, inventory is an asset. Assets have debit balances. So, debit balance, How much? 45. Trade receivables is an asset. Debtors, right? Trade receivables, 75. Allowance for credit losses. What is that? It's a negative asset. Same as before. Negative assets, close it off. Allowance for credit losses. What is the amount? 7,000. Okay, next. Pen and pencil. Are they good partners? Yes. 150 for pen. 84 pencil. Okay, current account. How do we close off current account pen? Let's show the working for this one. Current account pen, how do you close that off?
You debit current account?
No, you won't debit current accounts. Current account has a debit.
Sorry. You'd credit current account.
Yes. Okay, so current account pen, good or bad balance? Bad balance. Do you see that?
Yes.
Okay, he's drawn too much. Right, so the drawings would have been offset against the current account. That's how you land up with a debit balance on the current account. Right, you don't see any drawings here, do you? It's not here.
No.
Okay, the reason why it's not there, it's because the drawings was taken off the current account, because the current account represents their short-term entitlement. Right, so to close this account off, you would debit the capital pen and you would credit the current account pen. Okay, what is it? 30. Right, there's the working. See, workings are useful because then I'm going to show that here. What am I doing to the T account? Capital pen, debit. Debit, capital pen. With current account pen. 30,000. Right, so I've closed that off. I need to close pencil. How do I close pencil?
You debit current account
Good.
and credit capital.
100%. Yes. Nice. And you have to put in the amount. What is it? 10.
Yes.
Okay, so done. Got that? Got the working? What am I looking at? That. Right, what is that going to do to Pencil's account? It's going to increase their entitlement. Their equity will rise because of the current account balance. How much? 10. Okay, next. What's after that? Revaluation surplus. We spoke about it earlier. A revaluation surplus account has a credit balance. It's owner's equity. How do you close a revaluation account? You debit it. Okay, so now because this business is liquidating, now I can give them the benefit of those land and buildings they had purchased long ago, and it's been revalued. Okay, so the revaluation surplus is going to be debited. Capital, pen and pencil. Will be credited. Right, it's a benefit. Right, so the revaluation surplus was 270,000. Okay, they each get half. Alright, so pencil's going to get a portion, so is pen. Revaluation surplus. Okay, does it make sense?
Yes.
Good. Okay, great. That amounts. That amounts. Okay, next, mortgage. It's a loan. Loans have credit balances, so the mortgage needs to go there. How much? 300. Okay, the bank overdraft, we have an account for bank. Now we need to change the title. Overdraft because it's a liability. Okay, it's starting as a liability. It might end as an asset. Let's see what happens in the partnership. Okay, so because it's a liability, you would expect it to have a balance on the credit side. Okay, the balance brought down for this account is 90,000. Right, the trade payables is a liability. 145. There we go. Okay. All right, that's it. Yes, that's the end. Right, now what do we have? Is there any additional information? Yes, there is. All right, so 30th of June, the following transactions took place. Right, so on the 1st, land and buildings were sold for that amount. Okay. Notice, I'm not going to record any profit on sale. Anything like that. Why? Because I'm not operating. Okay, there is no statement of comprehensive income. Right, there's no 12 months financial year. There's no reporting on the financial performance during the year. Right, all you're doing now is you're literally realizing cash from assets that you have in the business. Does that make sense?
Yes.
Okay, and remember we said you're not going to have any other accounts other than liquidation, capital, and bank. Right, so if I'm going to be receiving cash, bank is going to go up. How does bank increase? By debiting the bank account. Do you agree?
Yeah, but
Good,
yes.
yes. Okay, so this is liquidation. What I do like to do is I like to identify what you've got here, because if you just have liquidation, it gets confusing. Okay, so I'm going to just add some more notes here. I'm going to write land and buildings, point 1. That's where that comes from. Okay, the amount here, 849,500. All right, if I'm debiting this account, where am I going to credit? The liquidation.
Liquidation.
Yes. Okay, remember it's a contra account. Right, what you write here, okay, is referenced there, and what you write here is referenced in the other account. So this is the blue that I had just looked at here. There's my debits, okay, there's my credits. And you would write bank here, asterisk, point 1, land and buildings. All right, same figure. Right, if they wanted a journal account, if they wanted a journal, you would write this down. Debit, bank, credit, liquidation, asterisk, land and buildings sold. That's all you would do. Right, there is no credit, land and buildings, because you don't have land and buildings anymore. Okay, everything is being simultaneously liquidated. This is why they call it a simultaneous liquidation. It's one account, it's not multiple. Okay, simultaneous, everything in one account. Okay, furniture was sold for 6,200. What are you going to do with that? Same thing.
Yes, credit, bank. Credit liquidation, bank, furniture, 60,200.
Yes.
And debit the bank.
Okay, and then you'll have lots of these accounts. There's another one, hey? Yeah, there's another one. So let's highlight 2 lines. Okay, then you'll have again liquidation, but now not for furniture, it'll be for vehicles.
Inventory.
Inventory. Sorry. Inventory, that's the right one. Okay, the amount 50,050. Double check. 50,050, yes. Okay. All right, and then same thing again. This will be referenced there. $50,050, great. Right, next. Debtors, as recorded in the above trial balance, settled their accounts and received a 20% discount. Right, again, you're not operating. There is no discount allowed, okay, because you're not running a business. Okay, you're literally realizing what an asset is offering in terms of value. Right, so the debtors offered us how much value? 75,000. How much value did you get in terms of cash? How much cash did you get? Did you get the 75?
No.
No. Okay, you only got 80% of it, right? 20% is the discount. So, copy paste. Debtors asterisk. Okay, I've got an asterisk, open bracket, 75,000 times 80%. Okay, 75,000 times 80% is 60,000. Right, that's what you're realizing in terms of cash. Cash is going to affect the bank. Copy paste. Debtors, same amount. Reference it. Okay, enter. Next, number 5. A previous client whose outstanding debtors account of 650 was written off as irrecoverable. Paid 500 to the partnership. Okay, what is this describing? What is the transaction describing? Do you know?
Not really.
Okay, if this was given to you in 1502, what would you do?
Oh, so
What
it's
would you
credit
credit?
loss. So if it was given to me, I would credit losses and wait.
Are you writing off bad debt here?
No,
What are
he
you doing
paid what
here?
he. So that I would debit bank.
Yes. And?
I would credit trade receivables.
No. Okay, you're not receiving money from a debtor. You're receiving money from a debt that was previously written off. Okay, so what do we call that? Bad debts recovered. Alright, so when you have bad debts, bad debt will arise and then you debit the... Okay, so when you wrote off the bad debts, okay, you debited the bad debts or the credit loss. Okay, you credit the debtors. Alright, that's when you did it. Did you do that here? No, you didn't. This you did previously, long ago. Does that make sense?
Yes.
Okay, this person, out of their own good faith, has come back to the business and said, sorry, okay, I didn't pay you in the past because I couldn't, but now I can. I see you're closing your business because maybe you're struggling now, okay, and now they're doing fine, and they're saying, well, let me pay you what I owed you previously. That's what's happening, and that's happening today. Does that make sense?
Yes.
Okay, so I'm going to have a debit for bank, okay, which is, what is the amount? Paid 500. Okay, bad debts recovered 500. Right, are you running a going concern? No, you're not. Okay, there is no going concern here. So, what accounts do you have open? Bank overdraft. Okay, so we need to show that income. Okay, this was from a liquidation account. Asterisk. Bad debts recovered. Okay, you can't use capital. You can't use capital. You have to use liquidation. Okay, everything is going to go through one account. All right, so this one I'm going to highlight actually. Let's use purple. Okay, you're debiting the bank and you're crediting the liquidation because you don't have any other accounts open. It's part of the liquidation process. This was something that actually happened during the liquidation, which is a benefit. Okay, it's a benefit because you're generating or receiving more cash. Okay, happy with that one?
Yes.
Good. All right, number 6. There were 2 vehicles in the partnership. Okay, Penn took over one of these vehicles at a fair value of 60,000 and Pencil took over the other at a fair value of 70. Okay, so we had vehicles. there's our vehicles, right? The partners are taking one each. Okay, so, oh, I need more space. Oh, this question is a long one. Not enough lines. Do I have anything at the bottom? No. Okay, let's add lines here. Okay. There we go. All right, so we read pen. How much did pen take? Pen took 60, hey?
Yes.
Okay, there's it there, hey? Capital pen. Right, why? Because basics. Okay, let me show this down here. Okay, or let me show it next to. Here, let's show it on this side. Alright, so how do you allocate a vehicle to a partner? You would debit the capital and you would credit the vehicle. Do you agree?
Yes.
But do I have a vehicle account? No, because I've closed everything off. I'm liquidating the business. So everything is just liquidation. You don't have to worry about all the other stuff. Alright, you always only have capital, liquidation, or bank. That's it. Right, so if it's not capital, if it's not bank, it must be liquidation. Does that make sense?
Yes.
Right, so keep it simple. Okay, you know how to allocate a vehicle to a partner if they take it. Right, it's part of the drawings. Right, you could have even brought drawings into here. Okay, then you could have debited drawings. But then if you're debiting drawings, then you're going to have to close off the drawings. Then you're going to have to credit the drawings and then debit the capital. End of the day, you're still going to affect the capital. Does that make sense?
Yes.
Okay, perfect. All right, so capital pen. We can write down what it is. Vehicle at, what is it, 60, hey, yeah. 60,000. Okay, so 60,000 is going to come out of the liquidation account because the vehicle is being given to pen. There's the 60,000. Right, and you'll do the same thing for pencil. The vehicle costs 70. Okay, 70 will go here. Pencil takes 70, pen takes 60. Next, the liquidation costs amounted to 10,000 were paid. Right, so if it was paid, what would you have done? You would have affected the bank. Do you agree?
Yes.
Okay, you would have
Credit.
debited the bank. No, it's paid. Other way around. Okay, liquidation costs. Credit the bank. Happy with that?
Yes.
Good. Right, do you have a liquidation cost account? No. Everything goes to one account, liquidation. You've got bank, you've got capital, and you've got liquidation. That's it. Right, so this must be the liquidation account. Alright, so credit the bank. Okay, if I'm crediting the bank, it's going to decrease or increase the liability, however you view it, okay? Because it was a liability, but now it's an asset because I've got lots of receipts here. Okay, but we'll look at that just now.
Yes.
What is this? Liquidation costs. Well, I should actually write liquidation accounts and then asterisk the liquidation costs. Okay, does that make sense?
Yeah.
Okay, 10,000. All right, so there's the credit. The working tells me to credit the bank, debit the liquidation costs. So, liquidation costs, color coding. This was bank, hey? This was asterisk liquidation costs. And the amount was 10. Right, next, the mortgage was paid in full. Okay, how do you pay a mortgage?
You debit the mortgage and credit the bank.
Yes, okay, so to pay, Bank is obviously going to decrease. We're running out of colors quickly. Let's use, I need to plug in. Sorry, my laptop's running out of power. Okay, there we go. Okay, so let's plug in the let's use a darker red, because I've got that red already. Okay, hopefully that's not too dark. You should still be able to see it. I'll bold it.
Yeah.
Mortgage, so liquidation. Okay, this is for the mortgage. All right, how much was the mortgage? They said the mortgage was paid in full. Okay, we'll reference the figure.
100,000.
Okay, let's copy that. What is the mortgage?
300,000.
Yes. Okay, there's the 300,000. Right, what else do we have? There's still more. All creditors were paid. A settlement discount of 29,000 was received. Okay, be careful. Don't get caught. Okay, remember, a settlement discount that's received isn't part of the operations of the business. Okay, so you wouldn't account for that loss, because the loss is actually accounted for in the actual T accounts when you're showing the net amount. Okay, so in other words, all creditors were paid. So in other words, the trade payables were 145,000. Okay, if I'm only receiving the net amount, obviously 29,000 will be seen as a discount that's received, and that'll be on the opposite side. Okay, so you're basically closing off the account as a benefit, right? So you don't have to ever worry about those adjustments as long as you're just realizing the cash, okay? Because the liabilities and assets have to be settled or received. Okay, I'm either receiving amounts from my assets that I'm selling, or I'm going to be paying off liabilities that I'm owing. Right, so here I'm owing a portion. Okay, how much do I owe? Well, bank asterisk, what is the amount? 145. Okay, less 29,000. Okay, here you do need to do a working. Okay, 116. Okay, so there's the payment. Debiting this account, crediting this one. Is that all right?
Yes.
Okay, this is liquidation asterisk. This was the trade payable. Look, I'm just going to write creditors. Okay, equals this amount. Okay, 116. There we go. There we go. I didn't write creditors here. Let's write it. Creditors. Okay, we've still got one more. Pencil paid 250 for a farewell luncheon out of the funds of the partnership. Okay, again, it's out of the funds of the partnership, so the bank is going to be affected. It's a payment, so you're definitely going to record an amount on this side. Okay, liquidation asterisk. This was for a luncheon, entertainment. The entertainment cost 250. There is no other account other than liquidation, so the 250 needs to go here. $250. And that's it. That was the end. That's the last of it. Great. All right, so now here comes the complicated bits. All right, the balancing off and then the closing off. All right, so if you look at the liquidation account, okay, because this is a working account, working accounts don't have balances. Okay, I can delete these lines. Right, so I'm going to close off this account. Total. Okay, what do? You sum up the left and you sum up the right. Okay, which side's bigger?
The credit.
The credit side. Good. Okay, you can see that this side is bigger than that side. Does that make sense? Okay, so if you know the side's bigger, right, you're going to have a
Yes.
balancing figure on this side. Okay, the balancing figure is going to be attributable to who? The owners. Capital, pen, and pencil. Right, and that's why when I did a what is it? The appropriation account. Okay, remember the appropriation account, the notes? Okay, and then I had a note here in one of the slides that said appropriation here at the top, and then I said here on this side you have a profit, and then on that side you have a loss, because it's either going to increase their entitlement or decrease their entitlement. Right, so if I'm debiting the liquidation account, okay, I'm going to credit the capital. Okay, so the liquidation account will be debited with the difference. So this minus the sum of all of that. Okay, write down that total on both sides. Okay, the balancing figure is this minus that. Let's just check it. This minus that. Yeah, it's right. It looks right. Okay, delete. Okay, half of it, divide by 2. Divide by 2. Okay, so pen gets a portion. Pencil gets a portion. They each get half of the entitlement. All right, and that's important to note. And that's going to increase their net worth. Okay, is that all right? Are you comfortable with that? Does that make sense?
Yes.
Okay, that's very important. This is the liquidation benefits. Okay, or the profit. I'm not going to call it a profit because they're not operating. All right, it's just the benefit that they're entitled to. It's going to increase the equity. Okay, so copy, paste, paste, liquidation. Right, so pen gets that, pencil gets that. Right, now we need to close off these accounts.
So does everything get closed off to the capital account?
No, the capital accounts will be closed off by the bank because they get paid out.
Okay.
Okay, you'll see that now. Okay, so do I have enough lines? Yeah, 3 lines is right. Okay, total column, total column. All right, let's add up. Sum up the left, sum up the right, sum up the left, sum up the right. Okay, there's our totals. All right, so you can see that both partners have equity in the business, and that's why I'm saying it's not often that you'll see a partnership end up with a debit balance on the capital, unless the value of the assets have depreciated so much that they're actually worth nothing. Right? As long as the partnership has assets, you should be able to get some sort of benefit from the partnership. Okay, so obviously that total is bigger. Okay, and then you can write a balance here. Okay, the balance is going to be this minus all of those figures. Okay, there's the one balance. This balance, okay, the total is that. Ooh, wrong one. There, this one. Okay, so there we go. All right, and then because you're closing off the partnership, you're liquidating the partnership, what must you do? Pay out the partners. Right, and this is the last step of the liquidation. Okay, this is the closing off. Let's use a different color. I've used black already. Let's use a dark color. Let's use that one. Okay, so bank, asterisk, paying out the partners. And then they go their separate ways. Partners. Okay, how much they pay out? They paid out that. How much they paid out? They paid out that. Right, and if you've done this correctly, you should get it to balance. Okay, so I need to show the capital. Capital pen, capital pencil. Okay, pen got paid out, 272. Pencil got paid out, 273. Okay, and then you won't have any accounts open because when I total up my bank, because I've paid out all the money in the bank account, the rest of it went to pencil, paid out. Okay, you should have 0 sitting here. Left hand side, that's the total. Right hand side, that's the total. It's correct. Okay, there you go. You've paid off the partners. All right, you've closed everything. You've closed off all the accounts to liquidation. You've closed off all the accounts to capital. You've paid out all the cash to the partners. The end. No more partnership. Okay, does that make sense?
Yes.
All right, and that's how you do a simultaneous liquidation. Okay, let's go look at the answers. Ooh, let's make this smaller. Okay, let's make this smaller. Ooh, that's a bit too small. Okay, hopefully you can still see that. Let's check it. Okay, they should have the same thing or similar. Okay, so liquidation. Okay, let's just look at the totals instead of checking everything. It's such a lot. Okay, 616375250. That's perfect. And the pen and pencil liquidation benefit was 137. Yeah, it's correct. Okay, it's perfect. Great. All right, pen's accounts. Did they show pen? Did they show pen? Oh, they only showed bank. Oh, they did show pen. Here's pen. They showed pen. Here's pen. Pen, yeah, same. Okay, final amount 2720. That's correct. Okay, they've closed off the count. Okay, I've worked out a balance first, then I close it off. It doesn't matter. Okay, they've just done it all in one account. They didn't have any balance brought down, carried down. Okay, this should still be marked correct. I've just done an extra step because of the balancing. I worked out their entitlement first, then I settled their outstanding balance. Okay, the amounts are still the same though. 422, yeah, 422. Is the other one there? Capital, ooh, they didn't label this person's account though. Whose account this is? Pencil. Okay, they should have labeled pencil accounts. Okay, the name's missing. Pencil's account, does it look the same? Yeah, it does. Again, I've just worked out the balance first, then I paid out the partners. The bank accounts, that was earlier. We saw that. Here's it. Okay, what is the bank total? Yeah, it's the same figure. Perfect. Okay, happy with their solution? It's in line with ours. All right, is that okay? Are you happy with that?
Yes.
Great. Okay, 5.2. How many activities are in this question? Can you do one of them? Oh, that's the last one. Wow, very short. Okay, I think there used to be more than just 2 examples in this chapter. They might have shortened it a bit. Oh, I lost my space, my place here. Okay, there we go. Right, exercise
There is also
5.2. Pardon?
There's 5.2 and 5.3.
Oh, is there 2? 5.2? Oh, here's 5.3. Yeah, but it's loss absorption. Yeah, this is different. I was hoping for more questions looking at the simultaneous, but it's fine. You can do the assignment question. Okay, you had an assignment simultaneous liquidation in the assignment in the first assignment submission. So now that you know how to do a simultaneous liquidation, I would go back to that question. I would do the question without looking at the solution, and then look at my solution and then mark it and see if you agree. Okay. Happy?
Yes.
Good. All right, let's have a look at the next bits. Exercise 5.2. What are we looking at? Piecemeal liquidation. Okay, so let's get a big column for this. I actually want to, I'm just going to move across. I'm just going to put an arrow here. Okay. I'm just going to move across. I don't want any workings. There we go, here. So I can change the column sizes. All right, I'm just going to start from here, from double A, okay? All right, so piecemeal liquidation. Okay, again, revision. What do we look at when we have a piecemeal liquidation? Important stages. Okay, always pay off liabilities or creditors first. Liabilities/creditors first. Okay, before any partners. All right, that's what you're looking at in a piecemeal liquidation. Okay. All right, so again, always start with what they've given you in the question. Can you tell me what those elements are in terms of their accounting elements? So in other words, asset, liability, income, expense, capital drawings. What is it?
So capital would be capital.
Good.
Equipment, asset, goodwill, asset, bank, asset, trade, payables, liability.
Perfect. Well done. Okay, so when you do a loss absorption capacity method question, all of that needs to be in a table. Okay, you're going to need a description here. Okay, the description is going to follow what's happening. Okay, and then you've got columns for all the other stuff. Okay, so first column, capital. Okay, let's use, what is it? Sausage roll. Yeah, they've used sausage roll here. Okay, I'm not going to use sausage roll. I'm going to use S-A... and R. Okay, we've got equipment. What else? Goodwill. Okay, bank. Trade payables, which is creditors. All right, those are your columns. Okay, columns are very important, especially with the piecemeal liquidation. Okay. Right, so what must I do? Well, remember, if you go back and you look at the steps, right, this question was very basic. They should have made this more complicated because they should have given you some balances for the current account and the drawings, because then you would have closed the current account to drawings. Do you agree?
Yes.
Okay, so what they've done is they've given you capital accounts after they've closed off all of those things. So capital balances, so let's just write balances, asterisk, after closing current / drawings / valuation / revaluation. It doesn't matter. You can have lots of those different considerations. Okay. The balances are as follows. Okay, for source 7,000, for age 14, for roll, 18,000. Okay, straight from the question, right? Equipment at carrying value. Again, they didn't have to give you carrying value. They could have given you equipment costs and then accumulated depreciation, and then you'd have to close off the accumulated depreciation to the equipment because you need carrying value. Right, so those are the type of things I did in that assignment question. Okay, the assignment question was better. It was more advanced. Okay, but when I say better, it had more steps. That's all. Okay, so more steps from the one that you've highlighted in the notes and what we saw earlier. Okay, in the study guide. All right, so 42,000 goes here. Okay, with the piecemeal liquidation, it's a very simple, easy process. But the most important thing that you need to understand is this whole idea of equity. Owner's equity equals A minus L. Okay, this is something that I like to keep track of so that you can see what's happening in terms of the owner's entitlement and what they're going to be getting as part of the partnership. Okay, so that's what I like to do when we go. I like to add up in total to make sure I'm on the right track because the accounting equation needs to be the same on the left and the right. Okay, so it has to balance when I do these types of questions. Okay, goodwill, 3. Bank, 5. Trade payables, 11. Right, so looking at this, okay, you've got partners, S, A, and R. Okay, you've got equipment of 42,000, you've got goodwill of 3. What must I do? I need to close off goodwill. Okay, what is goodwill going to do to the owners? Increase their capital or decrease their capital?
Decrease.
Good, it'll decrease. Why? Goodwill is an asset. When you close off goodwill, you will credit the goodwill. You will debit the capital accounts. Ooh. Okay, does that make sense? Are you happy with that?
Yes.
Okay, there's a little working. Right, so debit the capital means it'll detract. It'll take away from their ownership. Okay, what is their partnership sharing ratio? How much does S get? You give me that, some revision.
5/10.
5/10, good, I agree. All right, what is the goodwill? 3,000. Okay, times 5/10. Okay, how much does A get?
3/10.
Good. How much does B get?
You mean R? 2/10.
Sorry. A and B. Yeah, A and R. 2/10, yes. Good. Okay, so that amount should all add up to the goodwill. So minus this, minus gives you minus 3,000. Right, I like to do these little totals. So if I put a little total column here, okay, have a look at the current scenario. This is the equity that SAR have, okay, after having closed off the goodwill, because goodwill needs to be closed off. Right, do you still have equipment? Yes. Do you still have cash? Yes. Do I still have liability? Yes. All right, that's what you've got. Okay, if you look at this equation, owner's equity equals, okay, the owner's equity will equal the sum of those amounts. That's your owner's equity. Okay, your assets. Those are my assets. Your liabilities. Okay, A minus L equals 36,000. Right, so do you see how important it is to make sure that you're correctly adjusting for the piecemeal liquidation, because some partners are going to get paid out. Right, so let me ask you this. Okay, A S and R, okay, the three of them, want to get paid out because this is a partnership. Is there money available? Yes, 5,000. Who's going to get this 5,000?
None of them.
Good. Why?
Because you have to pay trade payables first.
Very good. There you go. See, your theory is good. Okay, so important. Pay off liabilities first. Right, so minus 5. Minus 5. Another total. $6,000. Right, and again, if you copy paste this, notice it's still 36,000. Okay, you've got assets of 42, you've got liabilities of 6. Assets minus liabilities, 36. It still balances perfectly. Okay, so looking at this, right, because this is a piecemeal liquidation, okay, I've got assets, I've got equipment, I've got liabilities. Is there anything to distribute to the partners? Nothing. Okay, creditors of 6 have to be paid off first. Right, so let's carry on reading the question. The partners decide to liquidate the partnership piecemeal. Okay, the net proceeds will be apportioned amongst the partners in a way that no partner will find it necessary to repay any amount which was previously received. Right, so in other words, the partners that receive money are the partners that actually are entitled to some sort of additional benefit. Right, here's your steps. Liquidation of assets, okay? Carrying amount, 13,000. Proceeds, 9,000. Right, what happened here? Tell me what happened here. What is the textbook saying?
Anthony, hello.
Yes?
You kind of broke up and I got kicked out of the class.
Oh, did you get kicked out? I see you're still in. I didn't notice that. Sorry, I've got this on the other screen, so I didn't see.
Yeah,
Okay, that's fine. If you lost connection and came back, where did I lose you? What didn't you hear? What is the last thing you remember me saying?
You stopped. The last thing you said was the owner's equity still equals the asset minus liabilities. For
Okay,
the last
perfect.
part.
Yeah, so that was the last bit that I said here, and then I just went to this question and I looked at this bit here at the bottom. That was what I was looking at. Okay, so you didn't actually miss much.
Okay.
I'm asking you about this one. Okay, the liquidation of the assets. What is happening here on 1st Feb? Tell me what's happening. Explain what they've given you here in the question.
So they sold off, I don't know what, but the carrying amount was 13,000 and they got 9,000 for it.
Yes. So what happened? Did
They
you make
ran
a profit or a loss?
Loss.
Yes. Okay. Do partners want to sell all their assets at a loss?
No.
No. Okay. So because they've identified this as a potential problem, they've decided to sell a portion of it and then they'll sell the rest at a later stage. Does that make sense?
Can you say that again?
Okay, they've made the decision to sell a portion of the assets. What assets do they have available? Equipment. Equipment is the only asset that they still have available. Let me copy these headings. Copy paste the headings here. Oh no, I can't because then that's going to go. All right, so let me just make it bigger actually. Actually, I only need this bit. Where's my snipping tool? Okay, just give me a sec. Let me just copy what I need. And then we can just look at the... Here. Okay, that's what I need. Okay, there we go. Let's put that at the top. Okay, so because this is the piecemeal liquidation, what they're telling you is that the equipment still needs to be sold. Okay, when did you sell equipment? You sold equipment. First sale, first stage 1. Sold equipment, bracket or asterisk carrying value equals 13,000 for 9,000 proceeds. Okay, there's the first stage. We need to record that. Right, carrying value 13,000. What's that going to do to my equipment? Minus 13,000 carrying value. Proceeds 9,000. That'll increase my bank. Okay, so I've got credit equipment 13,000. Debit the bank 9,000. I still need to allocate a certain amount of benefit to the partners, because who gets the benefit or who has to pay the loss if you've sold assets at less than the carrying value? Who takes the knock?
The partners.
The partners, exactly. Okay, so the partners are going to have to affect their equity, because they're not going to be entitled to more equity. They'll be entitled to less equity if they've realized the loss on the sale. Right, so what is the loss on the sale? Let's work it out. Loss on the sale is 13 minus 9, which is 4. Do you agree?
Yes.
Okay, that loss must be allocated to each of the partners. All right, so what is the profit sharing ratio? We had it earlier. That I actually need from the question.
5/10 for S.
Was it 5/10, eh? Yeah. 5 and then 3, 2. Okay, 5, 3, 2. 5, 3, 2. 5, 3, 2. Okay, so if we've got 5, 3, 2 as the profit sharing ratio, let's see. We've got 5 here. So the loss of 4,000 times 5/10. 3/10, 2/10. Okay. All right, new balances.
So after every transaction, we have to put new balances.
So your connection's not very good. I didn't hear the whole thing. What did you say? I only got part of it. I didn't get. You said after every balance, you have to do totals or what? Is that what you're asking?
Yeah, so after every transaction, do we have to put totals?
You don't have to, but you should if you want to be accurate, because at least then you can check.
Okay.
Okay, it depends on what they're asking. I'm just going through everything and I'm showing you everything so you get the right understanding. Okay, because if you understand how to do a piecemeal liquidation, you don't have to study it. Okay, that's why I'm showing this, because this is understanding. Okay, this is equity. Okay, so how much do I still have in terms of equipment? Wrong line. Where was the mouse? Here. Okay, this minus that, 29,000. Okay, did I get cash? Yes, I got 9. So 0 plus 9 is 9,000. Okay, and I still have liabilities. Right, have a look at that working. Okay, now I've got owner's equity of 32. I've got assets of 38, and I've got 6 liabilities, gives me A minus L of 32. Everything's still balancing. Okay, that you don't have to show every time. Okay, as long as you've got this. This is important, those lines, because those lines tell you what's happening. Okay, what I've got here is additional. That's additional. That's additional. That's additional. Everything else you have to have. Okay, you don't always have to add up and tally up. I'm just doing that to show you that there's equity that's being affected because the owners are entitled to it. Because it's going to make more sense when we look at the actual loss absorption, because now we need to decide who gets the benefits. Okay, so do we have cash in the partnership?
Yes.
Do we still have liabilities to pay off?
Yes.
Can I pay out any of the partners yet?
No.
No. So what must I do?
So you would minus 6,000 from bank and pay off trade payables.
Good. Pay off the remaining creditors. Nice. Okay, because they have to get paid out first. So, minus 6. Minus 6. Now the total. Okay, there's the equity. Alright, there you go. Next line. Alright, so look at this line. If you want to again, show the tally. There's the tally. 32,000 equity, 32,000 assets. Do we have liabilities?
No.
No. Right, so now we can pay out the cash to the partners. But now the big question is, who gets the 3,000? Did you have a question?
Yeah. Would you do the next part, which was sold on the 2nd of July first? Or would you pay them out first?
You have to pay them out because this is still the 1st of Feb. We're still sitting here 1st of Feb. This was still stage 1. This was 1st Feb. That was 1st Feb.
Okay.
And that was 1st Feb. Okay, we haven't even got to July yet. Okay, we're still looking at the money that they received from 1st Feb. Ooh, sorry, I pressed F1. Exit. Okay, there.
Okay.
Alright, so we're still at stage 1. We're not even at stage 2 yet.
Okay.
Okay, so this is something to consider. Right, hopefully they're not fighting over this money, but they could be. Alright, so who's going to get what? You've got 3 partners with equity in the business. You've got 3,000 that's available for them to fight over. Do we give it all to S? Do we give it all to A? Or do we give it all to R? Who do you want to give it to?
We'll have to work it out.
Yes, there we go. Right, and that's why you have a method. Okay, so when you have a loss absorption capacity method, it's to avoid disputes. Right, maybe they don't like each other anymore. Okay, maybe there's a reason why sausage roll wants to split. Okay, because S, A, and R don't get along. Right, so if they're not getting along, they're probably going to fight over the money so that they can go and they can leave and then have to be part of the partnership. Okay, that can happen. Right, so to avoid disputes, to avoid one partner saying, give me the 3,000 because I've only got 3,500 in equity, then the rest of you can fight over the rest of the assets. Okay, it doesn't work that way. Right, we need to obviously keep it professional and we need to make sure that there's a system that can apply. Right, so how do we do the allocation? We use the loss absorption capacity method. Okay, what I'm doing here is a working that's unrelated to these balances. Okay, that's why I'm highlighting this section. Okay, those balances are the balances and those balances will stay the balances, but only because I have cash that's available. I still have assets that can be sold, but I don't have any more liabilities, so this 3,000 can be distributed. Okay, so when you have other assets still available, asterisk waiting to be sold, and cash to be distributed. Okay, this is when loss absorption capacity method applies. Right, so how does it apply? It's going to be applied as follows. Okay, remember, if you go back to my notes and you read my notes from last week, okay, on one of the notes I said there, assume a maximum loss. Okay, maybe you remember me saying that last week. Okay, Assume a maximum loss. In other words, assume
Yeah.
0 left over. Then apply the splits. Okay, or the sharing, the profit sharing. Right, so what I said there in the note is what I'm going to do now practically. Okay, looking at a practical example. Right, in this example, Sausage Roll has equity of 32,000 in the partnership. Okay, this partnership belongs to Sausage Roll. Okay, Sausage Roll is going to have to distribute 3,000 to the remaining partners, and they're using the loss absorption capacity method. Okay, what the loss absorption capacity method says, it says, I'm going to use red here, assume a maximum loss. So in other words, okay, this is theory. Okay, if you read the textbook, you'll kind of get it. But just to summarize it for you, okay, if we assume that we're going to have nothing left over, in other words, we're going to assume a maximum loss here. All right, so loss absorption says, okay, assume this 29,000 Rand that's waiting to be distributed is worth nothing, and there's a maximum loss. Okay, this loss needs to be allocated to those partners. Right, so allocate the max loss. Right, how do I allocate 29,000? Well, minus 29,000 times 5 over 10, 3 over 10, 2 over 10. Okay, there's the maximum loss. The total is minus 29,000. Right, so I'm going to assume a maximum loss for the partnership. If I assume that maximum loss, who's still in good standing with the partnership? Let's check. There's S minus their loss. Okay, there's A minus their loss. Okay, there's R minus their loss. Right, so who's the bad partner?
Yes.
Yes. Should S get any of the 3,000?
No.
No, they should get nothing. Right, because they've taken too much during the life of the partnership. So why should they get paid out first? They must wait their turn. Okay, the other partners must share in the benefit first before we give S anything. S must wait. S drew too much during the life of the partnership. Their capital is lower than the rest. The other partners should get paid out first because they have more equity in the business. So they've kept more equity in the business for a longer period of time. Their capital balances are higher than the other partners. Does that make sense? Are you still with me?
Yes. Yes.
Okay. All right. So what do we do now? We've got A and we've got R. I don't have enough to pay A and R. Okay, we've only got 3,000. Right, so now what do? You need to allocate this loss. Okay, because remember we said when we looked at theory, S, A, and R, Sausage Roll, are jointly and severally liable for all the debts of the partnership. If A has a loss of 11,000, who takes on that loss?
A and R.
A and R, very good. See, that's the theory coming into something that's practical. Right, so A and R, they are going to have to take on that loss if S is in a bad scenario. Right, so let's split that. Allocate the loss, split the 11,000. Okay, how do I split the 11,000? Minus 11,000. How much does A get? How much does R get? Remember, we had this earlier. I'm going to copy this. I'm going to paste it here.
So 3 over 5 or 3 over...
Yes. I like how you're thinking. Your maths is good. Okay, you have to use the new ratio. The ratio in terms of R and A without S. Does that make sense?
Yes.
Okay, so S and R are going to get 3 to 2. So 3 over 5 for this partner. And 2 over 5 for that partner. Right, now we need to do the total again. Okay, who's the responsible partner now? Let's check. Ooh, A, bad partner.
R.
Ooh, R, good partner. Alright, so who has to take that loss? Who takes that loss?
R.
Yes, R is going to have to take that loss. And
R.
R still has some benefits. Okay, so we can say good R, good partner R, you can get the 3,000 and you can enjoy it. Okay, the other partners, you wait your turn. Okay, you were a bad partner during the life of the partnership, you wait for money. You were a bad partner during the life of the partner, you wait for money. Okay, this money goes to R. R was the good partner. They've left more in the partnership because their capital is higher than the other partners. Does that make sense?
Yes.
Okay, good. So then we can write that down. All right, notice this is all a working. All of that's a working. I can put all of that in purple. Okay, that whole bunch of workings is all working. That you should show, but it's shown as a working. Okay, what you need to show in terms of accounting is this. Okay, first interim repayment of capital to partners. Okay, I'm going to show 3,000 and I'll show 3,000 here minus 3,000. Okay, I just want to hide this for a second. Okay, all right, this is what you're showing. Okay, after having done that working, okay, 3,000. And then what do? Copy, paste, do the workings again. All right, so equity, that's what sausage has. That's what sauce has. That's what age has. And this is what R has. Okay, roll. All right, this is still going to stay there. This is going to go to 0. Okay, 3,000 minus 3,000 is 0. All right, have you done it correctly? Is the A equals O plus L still correct? Owner's equity, 29. Assets, 29. 29. Do you see that?
Yes.
Okay, good. Now you're asking me about the second liquidation, 2nd July. Okay, this is what we're going to look at now as the second stage. Right, so there's stage 1. Stage 1 is there to there. There's stage 1. That's the whole stage 1 bit. Okay, let's copy bold. Let's paste here. Okay, let's do stage 2. 2nd July. Stage 2. Okay, second stage, what happened? Go back. Here. We sold carrying value 29,000 for 33,000 proceeds. Do you see that?
Yes.
Okay, let's write that down. So tell me about the sale. Good or bad sale?
Good sale.
Good sale, yes. You sold 29,000 Rand worth of those assets that are remaining at 33,000. So was the piecemeal liquidation successful? Yes. Okay, remember piecemeal means you're going to sell your assets in stages. Okay, because it's not always advantageous to sell an asset simultaneous. If it was a simultaneous equation, it's like a garage sale. Sell everything, whatever you get, and then move on. Okay, that's not what they're doing. Right, S, A, and R, at least they're happy to stay until they've realized more in terms of the value of the assets. Okay, is the theory kind of making more sense now because you can see an example? That should be the case.
Yes.
Awesome. Good. Okay, that's the last step. Let's do the last step. 2933. 2933. Good. Okay, so what's step number 1? Same as before. Copy paste. Work out the loss or the profit. Here I have a profit. Okay, profit on sale. How much is the profit? Let's work it out. 29 less
4,000.
33. Should actually be the other way around. 33 minus 29. It's a profit, not a loss.
Yes.
Okay, gives you, it's 4,000, yeah. Okay, same amount, just a profit. Okay, are you happy with that?
Yes.
Good. Okay, let's show that. All right, so proceeds means cash. Let me get the headings again. Copy paste. Okay. How much is going to go in the bank account? Bank. 33,000 coming to the bank account. 29,000 Rand going out of the equipment. 4,000 Rand profit enjoyed by the partners. Asterisk, capital increases. Their entitlement increases. Does it make sense?
Yes.
Okay, 5 over 10. 3 over 10. 2 over 10. There we go. Okay, we've got them. Okay, let's put a total column. Actually, let's just copy a total column. Easier. There. Copy, paste. Okay, let's see what we've got. Okay, so this partner plus his entitlements. This partner plus his entitlements. Partner plus his entitlements. Okay, this is obviously going to be 0. Yeah, so I can leave a 0 there. 29 minus 29 is 0. 0 plus 33 is 33. Okay, is that matching? Yes, it's brilliant. It's perfect. If you add up all those amounts, you get 33,000. The owner's equity equals the A minus L. You only have an asset here, 33,000. Do you see that?
Yes.
Okay, let me ask you this question. Would you do loss absorption capacity method here?
No.
Why not?
Because there is no more assets.
Very good. Yes, nice. You have it.
To make
Excellent.
0.
Okay, no loss absorption capacity method needed. Why? Okay, no remaining assets. Still to be sold. All right, so you would write this down. Okay, so I'm going to copy that and paste that next to it. Okay, let's delete that. And then let's write this down. All right, second/final interim, or let's just don't put interim, final payment or distribution to partners. Okay, and this is where you liquidate the partnership. Okay, so it's different. There's no tier counts here. It's just a column. All right, so what would you have? You'd have minus that, you'd have minus that, you'd have minus that, and you'd have minus that. And then right at the bottom, you're going to show 0. Okay, partnership no longer exists. Everybody goes their separate ways. Everybody got paid out. Everybody's happy. And we don't have anything here. Okay, and that's where you should end up with if you're looking at a liquidation. A liquidation should always end with 0, 0, 0, 0, 0, 0, or if it's a simultaneous equation, with nothing in any of the tier counts. Okay, does that make sense? Are you happy with this section?
Yes.
Okay, good. Let's have a look at what they've done. All right, required. What did they want? Calculate the amount of cash that is available for interim payment after the first liquidation of assets liabilities. We spoke about it. Here, there, loss absorption capacity method. Okay, the amount of cash that's available after this first interim repayment was how much? It was, what is it, 3,000. Somewhere there, yeah. Let's go look at theirs. Yeah, 3,000, there's it. Bang, 3,000, 3,000, 3,000. They're showing it. Interim cash repayment, 3,000. Who is it paid to? Notice it's paid to roll. See, source gets nothing. Age gets nothing. Roll gets 3,000. Okay, the working's correct. Happy with that. Okay, they've even commented. There's it there. Okay. Is that alright? Are you happy with that?
Yes.
Good. And then here at the bottom, what did they show here? Balances immediately prior to the interim repayment. Okay, so I did that. That was in my table. Okay, balances there. My balances before the first interim repayment. Where is my first interim repayment? My first interim repayment was here. Okay, so my balances are there. There's my balances. 3.5 for source, same as them. 11.9 for age, same as them. 16.6, same as roll. Okay, 29 and 3, same as them. Okay, there's Eunice's working. All right, their working is fine. Okay, happy with their working. The capital balances after. Okay, this is just the working. Okay, I'm not going to look at the workings because the answer was correct. The workings are just to supplement their answers. All right, and that's it. Yeah, that was the end. They didn't even go right to the end. They stopped there. Okay, you've got a better solution. Okay, my solution covers stage 1 and stage 2, and it shows you all the different steps. Right? I like doing it this way. This is just my approach because it's logical, it's simple and easy to understand, and I like doing the little checks as we go, so I know I'm going to get full marks. Okay, if you're doing this online, if you've got Excel, you can do it like how I'm doing it. Okay, this is how I did your assignment. I did it using Excel, and I just updated those amounts as I went. And then I looked at the question. What did they want? Okay, did they want this? Okay, we'll choose that option. Did they want this? We'll choose that option. Okay, so try keep it orderly and try go through the process from start to finish. Okay, the start is very simple, where you just need to close off those accounts. Right, you weren't given any current accounts, drawings accounts, valuation accounts, revaluation accounts. It wasn't given. They only gave you the capital, the equipment, and the goodwill. Goodwill you had to close off. If there are other accounts, you do have to close those other accounts. Okay, let me see, what does this one look like? Recording a peaceful liquidation transaction in column format. Okay, fine. You've got Patris, Pine, and Promise. Okay. You've got the 3 Ps operating as African Timber. Here you've got property, plant, and equipment. You've got capital, and okay, even here they don't give you the current account. It's a pity. Okay, looks like you're going to have to look at past papers, and you're going to have to look at assignment questions where you're going to have to close off those other things. These are very basic examples, actually. And then they've given you, okay, here they've given you 4 steps instead of 2. Okay, and then there's a table here. All right, the solution is there, I see at the bottom. Can I give this to you as homework? Can you try to do this one the same as what I've done here?
Okay.
Okay, see if you can manage that. Right, it's a very simple process, but the first step is the hardest part because you need to get the allocation right. Okay, if you've got the allocation right, remember, close off everything first, then do it. Okay, or do you want me to do it now? It's up to you. How are we doing?
I think I'll try it for homework.
Pardon?
I think I'll try it for homework.
Okay, great. All right, Joe, there is a detailed solution. Let me just look at the solution and see how detailed is this one compared to the other one. Okay, this one looks better, but they don't give you as many workings. Okay, my table will be huge. Okay, it's not as small as this. They've obviously shrunk it a bit just to fit everything in. Okay, there are some workings here afterwards. Okay, here are the workings. Right, so UNISA shows the workings separately instead of with the actual with the workings. I like to do it as I go. Okay, like what I've done it there. Right, so as you do it, write your totals. Okay, when you get to a scenario where, okay, loss absorption applies when I still have assets. Do I still have assets here? Yes, I do. I still have equipment of 29,000. Do I have cash? Yes, I do. Do I have outstanding liabilities? No, I don't. Can I pay out the cash? Yes, I can. When this applies, when you've got cash and you've got other assets, then you have to do loss absorption capacity method. Right, then I do this little working here. Okay, this working I do separate. Okay, and then I just carry on my train of thought. Right, and that's why I like to highlight it, because it's separate. Okay, UNISA has just shown that as a separate working at the end of their solution. Okay, is that all right?
Yes.
Okay, perfect. So try that, see how it goes. If you do struggle and you do make a few mistakes along the way, let me know if you want me to go through it slowly and in detail, like this one here. Okay, I'm going to do lots of these, but not now when I look at past papers. Okay, so when I look at past papers, I'm going to do the same table. I'm going to go through the same process, but obviously I'll look at different questions. Okay, so ideally, I want to go and look at past papers as soon as we can, because then I can do more of this with you, and then we can create answers for past papers that you don't have answers for. Okay, you have a nice worked solution in your textbook, so I'm going to leave you with that one. Okay, a bit of homework to try. 5.3. See how that goes. If you have problems and you want me to discuss it in more detail, we can review it next week. Okay, sound good?
Yes.
Awesome. All right, so let's close off this section. We have study unit 6 now, which is the nice section. This was the easy one that I mentioned some weeks back. Close corporation, CCs. Okay, I've been waiting to get to CCs because this is a easy section. Okay, you'll like this section. Why? It's very, 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 very similar to normal disclosure questions for 1502. The only thing different with this section is the terminology, the vocab. Okay, so the vocabulary. All right, so we need to cover a few notes. How are we doing? I think we're okay. Should we take a quick 5-minute breather before we start a new section? Hey, Cheryl?
Okay. Can you hear me? Yes.
Okay, I can hear you, yes. Okay, that's fine. All right, let's take a 5-minute breather. Let's take a break. I'm just going to pause everything. I'll just pause the video. Okay, perfect. So before we start with the study guide, just want to take you through the notes that I have here for you regarding this section. Okay, just a bit of recap. Study unit 1, we looked at different forms of ownership. Sole proprietors, you've looked at in 1502. Partnerships, we've now covered in 1601. Remember, with partnerships, you've got 3 separate sections to consider. Normal disclosure, changes in ownership, and then liquidations. Purely because you've got a separate, let's say, partner or individual. Okay, you've got separate individuals working as one business. So the partnership conducts its own business, and you've obviously got to share the benefit from those or from the activities of the partnership to the partners. If you're looking at a close corporation, now we're changing perspective. Here you're looking at a separate legal entity. That's very important. And with companies, the same thing applies as well. Right, there's just a little note here in terms of theory. CCs were discontinued when the Companies Act was revised. And obviously now, because we have the new legislation, no CCs can be registered as new businesses. The only option you have now is either to go sole proprietor, partnership, or company. And then with company, you can either choose private company or public company as a possible form of ownership. It's important just to understand some context, because you still see CCs around, but you just don't see new ones. Okay, so the existing CCs will continue to operate, but they'll be treated like companies because they fall under the same legislation as companies for tax purposes, as well as also the legal requirements in terms of registration and so on. Okay, so first thing we need to look at, close corporations and companies, employees are just numbers. Okay, why? Can you elaborate?
What do you mean by employees are just numbers?
What do you think it means?
I don't know. Employees are just numbers. Are you saying like
an employee number? employee 1025 whatever. It links to this.
Okay, so that if new members come into the closed corporation, not much changes.
Yes. Okay. So
Or the business will still
employees.
continue.
Yes, employees aren't the business. That's the point I'm trying to make with this statement. Okay, the employees aren't the business. The business is the business. So the employees are just numbers. Okay, they're just employees in the business. We can have anyone as employee 10250. It doesn't matter who it is. Okay, whether it's you or whether it's me or whether it's someone else, it doesn't make any difference to the closed corporation. Right, and that's important to understand because they're separate legal entities. So when we talk about members, are members separate from the closed corporation?
Yes.
Yes, they are. Right, the members are separate, the employees are separate, everyone's separate. Right, because this entity has its own identity. It has its own registration number. In the eyes of the law, it's seen as a juristic person. Okay, juristic means in the eyes of the law, it's treated like an individual. Okay, obviously they're not. It's not a living human being, so it's a little bit different. Okay, so companies don't have human rights, or companies don't have those types of considerations. Okay, but companies are treated separately in the eyes of the law, and also for tax purposes for SARS. Okay, so SARS will also tax a CC separately than a partnership or a sole proprietor. Right, sole proprietors and partnerships don't pay sole proprietor tax or partnership tax. Okay, that doesn't exist. Okay, the owners pay the tax. Right, so if you're a sole proprietor, you pay tax on the profits you make from the business. If you're a partnership, the partners pay tax on their own individual share of the profit that the business generates. Right, if you're a closed corporation or a company, the closed corporation and the company pays its own tax. Okay, it's separate. Right, that's very important because when we look at this, there's the note about it. Okay, it doesn't matter who controls the entity, right? The entity will continue forever and ever and ever and ever and ever. Okay, as long as the company is obviously managing its operations and they've got enough capital and they can generate more income and have less expenses, right? Those companies and closed corporations can last forever. There's no end in terms of their operations. Okay, as long as they're continuing, they can continue many years into the future. Okay, large companies, some of the world's largest companies, actually Apple. Apple was in the news last week or the week before, I think. I forget when I saw it on the news. Okay, but Apple is the world's first $2 trillion company. Okay, so the big companies in the world, Microsoft, Apple, Amazon, Google. Okay, those companies are all worth more than $1 trillion, but that was a few years back. That was about 3-4 years ago. Okay, when those companies had first hit that mark, right, as a goal. Right, these are huge companies. Apple, in terms of size, in terms of revenue, in terms of operations, Apple is the world's first $2 trillion company. Right, in terms of how big their global operations are. It's massive. They're one of the world's, if not the biggest now, because of what came out recently. Okay, in the past, one of the biggest companies was, I think was it Amazon? I think Amazon was the biggest. But there's a few, the big five or the big four. Amazon, Apple, Microsoft, Google.
Walmart.
Facebook. No, Walmart's not one of the biggest. Pardon?
No, but their owners, because I think there's 3 owners and they always fall in the top 10 richest people for Walmart.
Walmart is a separate company. It's an American company. Walmart is separate. It's a separate listed company. Oh, I think you're thinking about Whole Foods. Whole Foods. Amazon owns Whole Foods. That's a different company.
Oh,
Yeah. So
okay.
it's like in South Africa, you've got like Woolworths and Checkers and Pick and Pay and Food Lovers Market. You have different providers of food. So Whole Foods, that's owned by Amazon. Okay, but Walmart
Okay.
is its own company. They're separate. Walmart is big in terms of employees and size. Right, they're huge. But in terms of revenue and value, Apple and those other companies, the tech companies are the world's most valuable companies. Okay, we could probably Google and find something if you're interested. Let's actually do that quickly here and just see, just out of curiosity, because you've mentioned it. Let's just type in world's biggest companies. Enter. Let's see. Okay, this is from Investopedia. Okay, I see you're quoting Investopedia. Walmart is number one according to Investopedia, but this
Yes,
is outdated.
Walmart.
Let's
Oh,
type in 2020. In 2020. Yeah, so depending on which website you're looking at, let's see.
it's Walmart. Yes,
The world's 10
Fortune.com.
largest. Okay, yeah, actually, you're right. I stand to be corrected. Okay, according to
Walmart.
this, okay, but that's not a very
Yes.
reputable site. But let's check Fortune. World's 500 largest companies. Okay, there, top 10. Okay, let's find something else. PwC. Or let's type in world's biggest or yeah, largest is fine. In 2020, yeah, I think that's fine. Top 10. Let's go that. Top 10 companies in 2020. Let's see. Okay, yeah, it looks like it is Walmart actually. Interesting. But yeah, Apple was in the news. Let me find that Apple article. Apple 2 trillion. This was in the news a few weeks ago. Here, New York Times. There, 19th of August. Yeah, it's a few weeks ago. It's actually quite outdated now. Apple is now a $2 trillion company. Okay, Walmart isn't a $2 trillion company, but it might be biggest in terms of size. But here's it here. This is from the New York Times. Apple reaches 2 trillion. Biggest techs, Apple is the first US company to hit this value. There's it. See? That was what I was referring to. Okay, no company. So Walmart isn't worth $2 trillion. Apple is worth $2 trillion. It's the world's most valuable company. Apple is the first US company to hit that value. Okay, that was the announcement that I was looking at. Okay, so maybe the way that I had phrased it wasn't correct. I said world's largest company. Right, so you're correct. Okay, Walmart is the world's largest company. Walmart is the largest company, but not the most valuable. Largest company in the world. Enter. Okay, 2020. Okay, 2020 does. Oh, where's that nice list that we had earlier? Let's don't say Walmart. Let's just say largest company. And then we had that list, right? Yeah. Now here's the list. Okay, but now why is it changed? Now you've got China National Petroleum on the top. Ooh. Let's say biggest. Where was that one we had?
Let's
Stop bringing it up now. Okay, I don't want to use that because I don't recognize that link. I do recognize Forbes though. So Forbes is definitely a lot better, but they've got top 2000. PwC, top 100. Maybe, let's see what they say there. And let's open up this one, Global 2000. Yeah, is Walmart the largest? It probably is because they do employ lots of people around the world. Let's see. No. Okay, these are top 100. These are sectors. No, not quite right. Global 2000. Okay. All right, but yeah, this was the one that I was looking at. This was what was interesting to me in terms of what was announced recently. This made the news in terms of Apple's market value. So in terms of value, Apple is the most valuable company. And notice, Apple reached $1 trillion 2 years ago. Okay, so back in 2018, okay, Apple reached $1 trillion. Today, Apple is worth double. Right, so I don't know if you're an Apple fan. If you are, maybe you'll like this news headline, but it just shows you how far and how fast this company has grown over a very short period of time. Right, Apple, if you look at their value, okay, not worth a lot, and then it just from the 2000s, just huge exponential growth. Okay, quite a nice article. You can have a look at this if you're interested, and you can see a lot of the world's tech companies have increased in value rather than decreased in value during the coronavirus pandemic. Right. So even though the world is going through this global pandemic, there are still companies out there that are growing and not shrinking. A lot of them are tech companies. Google is bigger now. Amazon is bigger now. Microsoft is bigger now. Apple's bigger now. Those tech companies have grown a lot more now than before. Okay, okay, this is loaded. Okay, on this list, the list Global 2020, Global 2000. Okay, this list is also a bit different. Here you've got ICBC. Okay, this is obviously Chinese companies. Then you've got JP Morgan. Here they've got Apple at number 9. Okay, but this is obviously, okay, market value. Okay, so here they're looking at assets and they're looking at profit. I think here, okay, so different lists have different criteria. All right, so on this list, on this global list, Forbes global list in terms of public companies, here they've identified ICBC as being the largest in terms of assets. Okay, so assets here, that looks like the biggest. It's bigger than everyone else. Okay, market value, it's not the biggest though, because you do have other companies that are bigger. Apple here, Apple 1.2, that's $1 trillion. Okay, 1.2 is $1 trillion. But obviously, I don't know when this was conducted. Maybe we can find a date here somewhere. Is there a date at the bottom? No. Is there a date at the top? May 2020. Okay, that's a few months ago. Okay, we're sitting in September. This was the news that was launched recently. Okay, yeah. So I do think Walmart is the biggest, but I think biggest in terms of maybe employees. Let's find that. Walmart. Here. Okay, there. Walmart is the world's largest company by revenue. This is according to, okay, this is a Wikipedia post, so also not reputable, but we'll take this according to the Fortune 500 list in 2019. Yeah, it's the largest employer, employing over 2.2 million employees. They're huge. Yeah, so definitely a huge, massive company. Let's see. Yeah, here's another one. Amazon surpasses Walmart as the largest retailer. Okay, yeah, so I'm not too sure why we got that note. So when we Googled it first, Walmart biggest company in 2020, we got Walmart here, but now it's not coming up. Okay. Yeah, it could be one of the biggest, definitely biggest in terms of employees. That I would agree with. But yeah, we'll probably do a bit more research. But yeah, not to digress too much, that was the article that kind of impressed me in terms of operational size and value. I mean, Apple is a huge company in terms of value, and it's doubled in the space of around 2 years, which is remarkable to think how much they've grown in light of everything that has taken place. And this is even during COVID. This was obviously reported on, when was it? Where was that date? It was recent, right? Yeah, here, August. This was, I think this even, I saw it on the news, and then obviously This is a reference here, New York Times. Okay, yeah, fascinating. All right. Okay, happy? A little bit of general knowledge, I guess.
Yeah.
Okay, but yeah, it's fascinating to see how some of these companies are dealing with different opportunities, but also threats to different markets. Okay, so yeah, Apple's the first $2 trillion company according to the New York Times, that article that you just saw. What's important here is they're separate. Okay, Apple will probably be around for the next 100, 200, 300, maybe even 400 years' time. Okay, who knows how long Apple will continue to operate. Okay, there are certain companies that are very old, maybe even 200 years old. All right, I know JP Morgan's a very old company. Obviously, these tech companies are very, very new. Okay, they're not very old companies. In the 1980s, we saw that here on the graph. Okay, Apple was founded in 1975, 1976 actually. There's it there. Okay, so Apple is only a what? Let's see, 24 plus 20, a 44-year-old company. So probably the age of maybe your mom or dad, right? Somewhere around there, perhaps.
Yeah.
Okay, very, very young company. Right, but then if you look at the likes of JP Morgan, they're very old. They're about 180, maybe 190 years old. Let's just check. JP Morgan, founded in what year? Let's see here. JP Morgan Chase, founded. No, that's not JP Morgan Chase. Let's just go JP Morgan, not the Chase. No, it's definitely not 2000. JP Morgan's been around for many years. Let's say, when was it founded? When was JP Morgan founded by the founders? Yeah, there's actually, there, 1871, JP Morgan and Co. Okay, there's if you're interested in this type of stuff, there's a really good, I think CNBC generated or created a documentary on JP Morgan on Google actually. And I actually watched it. It was quite interesting. This was during COVID and obviously being under lockdown. I actually watched a documentary about JP Morgan and how they became the world's, one of the world's largest banks in America. So there, 1871. Wow, that's very old. 1871, let me grab the calculator. 2020 minus 1871, 149 years. Okay, and they'll probably be around for another 149 years. Right, so the point is, these founders, these companies, let's just go JP Morgan, CNBC, YouTube. Yeah, this was it. How JP Morgan Chase became the largest bank. Okay, it was uploaded by CNBC. Very interesting. If you like banking, if you like finance, that's quite a nice, easy to follow history of one of the world's largest banks. I think they might even be the largest bank based on certain measures. Okay, but yeah, fascinating. Banks, 149 years old. Apple, 44 years old. Okay, those banks and those tech companies will be around long after we've passed on. Okay, they'll live hundreds of thousands of years depending on how far those companies go. Okay, so the point of this discussion is to highlight that companies are separate, closed corporations are separate. Does Apple pay tax? Yes. Does JP Morgan have to pay tax? Yes. Okay, so we're looking at the closed corporations as a separate legal entity. Closed corporations also have to pay their own tax because they're separate legal entities. Right, so what do we call the owners of a CC? Do you know? No audio's coming through. Cheryl, can you still hear me? I can't hear you.
Can you hear me?
Okay, that's better.
How about now?
Yeah, the audio's up
Members.
now. Owners of CCs are called?
Members.
Perfect. Right, members are then going to contribute manual assets to the business, and you're also going to have capital, but we just don't call it capital. We call it members' contribution. All right, so the only thing new here in chapter, I think this is 6 in your study guide. It's unit 5 here in my notes. Okay, learning unit 6, close corporations. Members' contribution is what we refer to when we talk about capital for a CC. And you can have bank and you can have assets as well. You'll debit the bank or the assets, you'll credit the members' contribution. What do we call drawings for members? A distribution. Okay, it's a distribution that's either paid or it's a distribution that's payable. Right, those are two things that you'll see in different questions. Okay, if it's payable, it's a liability. If it's paid, it's then seen as an expense, or more like a distribution. Okay, more like drawings than an expense. Okay, like an expense, because remember it's separate. Okay, so if you have a close corporation, okay, you have to account for the distribution that's paid to the actual members, and you don't have to pay all the distributions. There's the note about the retained earnings. Now, this I think you asked me about when we did the assignment. Okay, profits may be retained for future growth. Right, companies and close corporations don't always pay out all the profits they generate. Right, it's the same with a sole proprietor. Okay, if a sole proprietor has, let's say, 10,000 capital or 10 capital, okay, and he makes a profit, and the profit is 100,000. All right, does the sole proprietor have to pay out all the profit? No, they don't have to draw all the profits. They can add the 100,000 to their capital. So then next year, their capital will be 110,000. Next year, they make 150. Okay, they don't have to pay out all of that, and then it gets added to the capital again. Right, so for a sole proprietor, you don't call it retained earnings. You just call it profit or capital, right? The profit that's kept as capital. That's what you're looking at here. Okay, when you're looking at a close corporation or when you're looking at a company, you have to distinguish between profit that's paid out and profit that's retained. Right, when you look at retained earnings, you're looking at the profit that was not distributed, and it's therefore classified as owner's equity, right? Because it still belongs to the owners, or in this case, the members, or if I'm looking at a company, the shareholders, right? The shareholders, the members will always be entitled to the profit. They might not get it now, but they'll get it later on. Sometimes companies choose to retain the profit because they want to grow. Right? And if you go watch the backstory about Apple, okay, we spoke about Apple earlier. I'm going to speak about them again. Right? And if you go watch, there's actually two films about Apple. The one is called Jobs, okay, with Ashton Kutcher. That's the slightly older one. And there's another one called Steve Jobs with Michael Fassbender, something like that. Okay, there's two different Apple films about the Apple story. So yeah, I like watching knowledge, like information type stuff. Like I'd rather watch a Steve Jobs biography than I would watch, I don't know, Harry Potter or something like that. Okay, I'm not saying that Harry Potter is bad, but there's nothing wrong with Harry Potter. It's nice just for entertainment. But I mean, I've watched Harry Potter, but I would prefer watching like stuff that you can actually learn something about. So those films are very entertaining. The Steve Jobs film. Steve Jobs actually passed away. So they've made films about his life. And if you go learn more about Steve Jobs and you learn about Apple, one of Steve Jobs' philosophies when he was building Apple, so from 1976, is Apple never ever paid out any of its profit. Whatever they made, they plowed it back into the business. Right? And that's why Apple is so successful today. It's because Steve Jobs had laid the foundation. If it wasn't for Steve Jobs, Apple wouldn't be where it is today because they wouldn't have retained so much of the profit. Most companies pay out a dividend, right? A dividend is a form of profit that gets paid out. This we'll look at in the next chapter. Okay, when we look at companies, right, you'll see dividends being spoken about there, right, and then maybe we can look at that in more detail. Right, but I'm just sharing that with you now because it's the same. A closed corporation and a company, they're exactly the same in terms of the eyes of the law. Right, in South Africa, you can't register a CC. You can only register a company in today's world. Okay, the existing CCs operate like companies. Right, so companies don't have to pay out profit. There's nothing forcing a company or a CC to pay out anything. If they want to retain all of it, they can. If they pay out some of it, it's a distribution. If they keep it, it's retained earnings. All of this will affect the statement of changes in equity. The disclosure is important here. And disclosure will always be important for these types of questions, okay, or sections. All right, and then you've got closed corporations here. A note about the legal entity. We spoke about this. It's separate. What are the tax implications? This you can answer already. You know the answer.
So not the company, but the CC will pay tax.
Good. Okay, so when they pay tax, you will have two accounts. You'll have an expense account and you'll have a liability account. Right, the liability account is showing the amount of tax that's payable. If it's payable, it's outstanding. It'll be disclosed as a liability in the statement of financial position. Okay, if you're looking at the expense side of the tax, right, the tax that I actually pay, okay, or the tax that I incur during the year. Okay, remember I'm using the word incur because we spoke about the accrual system. Okay, if I've incurred tax during the year, I have to record it during the year. So that means I have to disclose it as part of the statement of comprehensive income because it's part of your operations. Okay, and you'll see this when you look at disclosure. When you look at profit for the year, okay, when you had a sole proprietor, you stopped there. That was the last line. In this particular section, okay, you will have profit before tax, and then you'll have tax. And then you'll have profit after tax. And that's what you're going to disclose as part of your statement of comprehensive income, and that'll be transferred to the statement of changes in equity, okay, because the owners get the profit, but they get the profit after tax because SARS is going to want their share of the profit. Right, do you know how much tax companies pay in South Africa? Closed corporations and companies pay the same amount of tax. Do you know?
Is it 21?
No, it's too low, 28.
No.
Okay, 28%
okay.
is corporate tax. Okay, you do get other tax rates that apply to different types of small businesses. Right, there are certain types of small businesses. Let me ask you now, while we're discussing tax, do you have to do any tax modules as part of your BCom?
I think I can choose to do tax.
Oh, but you don't have to. It's not mandatory.
No.
Okay, well, it's up to you. If you do want to learn a bit more about tax, there are some nice modules covering tax. But with tax, it changes every year. But this hasn't changed. Okay, this has been 28% for quite some time now. Corporate tax. So corporates pay 28% on the first rand that they generate. So every rand that they generate, they have to pay 28% tax on that. You do get other types of businesses, small businesses, micro businesses, special types of businesses, and then the tax rates are different. Okay, but the companies that you'll see in this module, okay, in accounting, in finance, in investments, all of that, you'll be looking at corporates. Okay, corporates are big businesses. Big businesses have to pay 28% tax in South Africa. Okay, and there's the note about the calculation. Okay, it is done separately, and you've seen that in the assignment, but you'll see it again when we do these questions that you'll see in your actual notes. Okay, I just want to cover the theory again this week. I'm not going to start with the practical. Okay, we can leave the practical for next week. This is actually a very nice section. So you'll see next week it's going to be quite easy to cover because a lot of it you already know because you are familiar with those adjustments. Okay, from a sole proprietor point of view, right? So I'm only going to do one of the examples with you because it's that easy. It's not very difficult. And then with the other examples, I'm not going to look at the adjustments, but I'll look at the disclosure in terms of this. Okay, when you look at sole proprietors, you don't have to worry about the statement of changes in equity, but you do for all the other types of businesses. We looked at the disclosure when we looked at partnerships. Okay, we had to draw different columns, and there was an appropriation column as well that you had to bring in to the disclosure. Okay, the same applies here. NB disclosure is key in 1601. Okay, and that's why when you look at past papers, UNISA likes to test you on the SOCI because there's so much that they can test you on. They can give you a partnership question, you've got different SOCI disclosure there. They can give you a membership, a closed corporation disclosure question, and then the same thing applies here. Okay, the only thing different here is the column names. Okay, so when you have a member's contribution, you will show that as capital inverted commas, okay, in the statement of changes in equity. There will be a column for members' contribution. Okay, there will be a column for loans to members and a loans from members. The reason why is because, yes, those members are separate to the business, but they're still owners. They're still part of the owners of the business. In other words, the ownership is still relevant. So when you have the SOCI is the changes in equity, and we know equity relates to owner's equity. Right? Owner's equity talks about ownership. Okay, so in terms of the IFRS disclosure requirements, you have to disclose your members' contribution and any transactions that pertain to those members. So if you have loans to or loans from, it needs to be disclosed as well in the statement of changes in equity. You're also going to disclose it in the statement of financial position, but there's added disclosure. Okay, you're not double accounting, it's just you're double disclosing. Okay, disclosure just means communicating information in a specific layout and format. Accounting is accounting. Debits are credit. Debits, credits are credits. Every debit has a credit. Okay, so you're not going to be double accounting for the loans to or the loans from, but you have to disclose it. In other words, the presentation is important. It's the same with like a note. Okay, think of a property, plant, and equipment note. Right, if you've got a note on PPE and then you've got the same amount in your statement of financial position on the face of your assets, your non-current assets, you're not double accounting. Okay, you're just adding more disclosure. Okay, so notes add more in terms of disclosure. This is just something that you have to add as additional disclosure. Right, so let's test your basics. Do you know what a loan to members would be viewed as? Asset or liability?
Asset.
Good. Because it's from the closed corporation's point of view. Okay, remember, it's a separate legal entity. That's very important. You have to view it as being separate. Right, so we spent quite a bit of time discussing some companies that are separate, and we looked at some other information. Okay, the point of that was to emphasize how important it is to identify these organizations as being separate. These companies will continue forever and ever and ever and ever. Okay, if a sole proprietor dies, the business dies with the sole proprietor. If the partnership dies in terms of a member retiring, the partnership ends. Okay, if someone retires, it ends. If someone dies, it ends. If we get a new partner entering into the business, the old partnership dies, inverted commas. Okay, there's no separate legal entity. Right, that's something to note here. Something else to note, when we looked at salaries to partners, okay, maybe you can remember this from our study unit, I think it was 2 or 3, one of the two, okay? When we had salaries to partners, did we put salaries to partners in the statement of comprehensive income? The answer is no. Okay, you can go back and you can look at your notes. When we look at partnerships, salaries to partners only went to the statement of changes in equity. Okay, salaries to partners, and you disclosed it under appropriation, okay, where you showed salaries and you took it out of appropriation and you assigned it to the current account. That's what we did when we looked at partners. Are you going to do that here? No, you're not. Okay, because we spoke about it earlier. Employees are just numbers, right? You will have the salaries and wages disclosed as a normal expense, as part of your operational expenditure in your statement of comprehensive income, right? And that's why everything is so simple, because the business is separate. Everything is separate. So all the disclosure is separate, right? So you will see salaries for members or salaries for a specific individual. Sometimes they even disclose the salaries for the accounting officer, okay, or the director, okay, the member, all of that. Okay, all of it must be disclosed separately, and you will see it in the normal operating expenses. Okay, there's the note about disclosure. NB, layout and format for the SOCI. Right, if we do a SOCI, I'm going to use these column names. You will have members' contribution as a column. You will have retained earnings as a column. You can have reserves as well here. Okay, reserves, remember we said, is just a valuation of a specific asset. Okay, like land and buildings. Okay, you asked me about that in that what is it? The liquidation. Okay, about the revaluation, and we discussed it in quite some detail. Okay, you're going to have the same thing here, and you'll disclose it as well here. Notice this is the additional disclosure. Okay, it's based on IFRS. You have to also show the loans to and the loans from. Okay, so it seems a bit odd because loans to is actually an asset. Yes, it's an asset, but it's an asset that belongs to an owner. Okay, a loans from, same thing. Okay, loans from, it's a liability, but it's also part of the owners. Okay, the members. Members can give loans. Members can take out loans. It all relates to the owners as well. Right, and that's why you have the special, inverted commas, disclosure. And that's it. That's the end. All right, so I'm going to give you a little bit more homework just to get you to think about some of the disclosure. Okay, so if you go look at your study guide. Okay, next week I want to just start with the practical questions. I don't want to cover any of the theory. Okay, so I'm going to use the next 3, 4, 5 minutes or so just to show you what I mean. Okay, if you look at the textbook, okay, the Learning Unit 6, you'll see they obviously reference the textbook. They talk a little bit about the background regarding the Closed Corporation Act. Okay, this Closed Corporation Act no longer exists because it was brought in line with the Companies Act. Okay, so closed corporations follow the same rules and regulations like normal companies. Right, you do get different types of companies, okay, but that's a whole separate discussion. Okay, these concepts you do need to know. The ones that are important, I'll highlight them for you. You do need to know what limited liability is, and you do need to know what members' contribution is. Members' interest is just their investment. In other words, the percentage. Remember, when we looked at partnerships, we used ratios, okay, a profit-sharing ratio. In members' contribution, okay, you've actually got shares, okay, or an interest. They talk about an interest in the business. Right, so if you're a member of a CC, you'll have a percentage of the business, and that'll belong to you. Okay, an accounting officer is obviously someone that needs to be responsible for the books, financial statements, profit distribution. That's also important because we looked at a distribution as being either an amount that was paid or an amount that's outstanding. Okay, if it's outstanding, it's seen as a distribution that's payable. Right, these are things you'll see in practical questions. Loans to and loans from, I've got that in your notes. Okay, we just saw it earlier. Retained earnings, also, you saw it in the notes, is owner's equity. SARS is important because you will have tax. You can have a liability, so you can have tax payable, and you can have tax expense. Okay, sometimes they use different words to describe it. It doesn't matter. Sometimes they don't even use anything here, and they just write tax bracket credit. Credit means liability, and sometimes they have tax bracket debit. Debit means expense. Okay, that's where you need to remember your basics. Right, so if you've got tax liability, it'll have a credit balance. If you've got a tax expense, it'll have a debit balance. And then there's that note we spoke about earlier. You'll have profit before tax, and you can even add to the textbook, you'll have profit after tax. Right, and that's all that you need to know in terms of vocab. Right, everything else in terms of accounting, 1502. Right, you'll like this section. And that's why I'm saying I want to give you some adjustments to look at again. It's been a while since we've looked at adjustments. We looked at adjustments right at the beginning of the course. Okay, that was several weeks back. We've come quite a long way. We're now looking at this Okay, this is all theory. You can go look at this. A lot of it I've touched on when we looked at the notes. I want to look at an activity here. Activity 6.4. Here are some adjustments. Okay, these adjustments aren't adjustments that you can do. Those ones I will do with you. Okay, because I can see it's looking at contributions and profit. Don't worry about that. I'll cover that with you. There should be a disclosure question. There always is. Here, exercise 1. Okay, not the example activity. That one we can discuss. This one is what I want you to look at. Okay, here you'll have all the disclosure. Okay, interest. That one you can do. Provisions you can do for depreciation. Improvements to buildings. We've discussed it. You might or might not remember that. Okay, that was something that I had covered with you in the first week. Okay, that I'm going to put a little asterisk. That one you can do if you remember the first week's content. 1 you can do, 2 you can do, 1 you can do, 3 you can do. 4 you can do. That's looking at either an accrual, okay, so prepaid or accrued expenses, either or stationery on hand, that type of thing. 5 you can do. Writing off bad debts. 6 you can do. Providing for interest on a loan or interest on a, well, it's a loan, but it could be a loan to a member or a loan from a member. It doesn't matter. A loan is a loan is a loan. Okay, you still have to calculate interest using the same formula. Interest equals principal times rate times time. That'll apply to any interest calculation, irrespective of what the loan is. Okay, if it's a loan to a member, it's the same thing. You'll just account for it differently. The accounting I can do with you. Okay, but please do the workings and the calculations. Right, try to that one. The tax you don't have to do. That I'll do with you. That you don't know. The retained earnings you don't know. That one you can leave as well in terms of the distribution. And then that you can leave in terms of distribution. Okay, so you have 1, 2, 3, 4, 5. Okay, you've got 5 workings to do. When I talk about workings, I'm referring to the debits and the credits, like what we did when we looked at those initial disclosure questions right at the beginning.